And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. Okay, welcome to my podcast. So today, again, after 10 straight days where the market drops in the evening when we close, then the next morning it's always positive. And of course, a lot of that has to do with the plunger team. This is going on for 10 days now, but today is different. Today, we opened up, the market was lower. Market was lower on this opening instead of high. Now, the reason you always, in the last 10 trading days, you see the market always close low than open high, because they always make sure they feed you enough information that helps the relief rally. In other words, you are going to be relieved to hear what they're telling you, like Iran. So this whole relief rally is based on feeling relieved. And that's a dangerous market. And that's why relief rallies are so dangerous. And that's why they don't hold. That's why you only have 3 stocks holding up the whole market. Now, the other thing that's been going on that nobody wants to talk about is the banks. The banks are incredibly important. And ever since we had the financial crash in 2008, banks have been propped up. Now, banks, they're holding up, but the banks are not strong. They're not leading because, again, like now, the yields aren't rising. And the curve, remember this yield curve, we need to have this yield curve heading towards 150. It's got to hit 150. We're still in the low 50s. So banks are not weak. They're stable. I mean, there's not a lot of stress. There's no credit panic. They still are, lending money. But the big problem we're having with the banks is that the folks are taking money out because, like I told you yesterday, they're going in and buying. The government's saying, "Hey, come out of the banks. Instead of getting 1%, I'll give you 5%. The government will pay you 5%. They'll give you a T-bill. They want to borrow your money, so take your money out of the bank, and we'll give you 5%. Well, the big problem with that is the more money they take out of the bank, like I said yesterday, the less money the banks have, the more interest rates go up, because when you have less money, you don't want to run out of the bank, right? So you have to raise your rates because you don't want people coming to the bank looking for loans because you don't have enough money. So it really hurts the economy. But banks, they don't want to talk about banks. And banks are everything. And again, banks are not strong because the yield curve is still wrong. And when you hear yield curve, everybody makes it so complicated. Just think of 1 to 150. You got to get to 150 on that yield curve in order to have, where the institutional money will come in. And if you don't get that institutional money come in, you're going to have problems with your rally. And that's the problem we got right now. The only institutional, it's my partner. What do you want? He wants a cookie. Here, I'll give him a cookie. Will you please trade? He doesn't trade enough. That's the problem. Come here. All right, well, take the cookie and go. I'm babysitting again. So right now the banks need long-term yields. They gotta go higher. And let's take a look at the yields now. If we take a look at the yields right now, let's pop them up here. Okay, you can see where the yields, if you go back to, let's take the low back here in, we've been stuck in this area of 4.25. See that 4.25 right there? We're stuck in that 4.25 area. Right there, 4.24 actually. We're stuck in it, and we just can't get those yields back up to where we need to be at 4.4. Now, as we get closer, again, to 4.7, that can create a crash. So the Fed's got to know what they're doing. And the problem is the Fed doesn't know what they're doing. So again, banks aren't weak. They're stable. You still can get loans. Credit quality is still good. Loan losses are normal. So this is not 2008, 2020, 2023. But we have a crisis in a sense that the more we spend, our government, than we take in tax revenue, we have to keep borrowing money. And we're now paying folks 5% on T-bills, and money is coming out of the banks. That's the big problem. We're having a big problem with that. And the problem is when money keeps coming out of the banks, that can hurt the rally that we're in right now. Anytime you have a rally like we do, a relief rally, a fake rally, where you have just 3 stocks running the whole market, we could have that can backfire quickly, and you could have a big correction, like overnight. So you got to understand that. So, and the other problem we're having is, why is loan growth so slow for these banks? Now remember, the banks are so important. It's the backbone of our country. But the problem is, loan growth is slow for the banks. Why? Because when you keep spending more money than you take in, the government, that becomes a real problem. We have to keep borrowing money from the folks and paying them 5% interest on these T-bills. And we can't keep doing that, because the more we pay people 5% on a T-bill, the more mortgage payments go up, the more car payments go up, small business loans. One of the biggest problems we have in our economy's growth is that small businesses are getting crushed. The rates are too high. They can't expand the small businesses is the backbone. And when small businesses go to a bank and they try to borrow money, we're competing with the government. So you have the government in there, hey, I'll give you 5%, I'll give you 5%, give you 5%. Then the guy's got a nice little business. He needs to fund his accounts receivables and goes to the bank thinking he's going to pay maybe 4%. So he's paying 12%. What the hell happened? Oh, we don't have enough money. What do you mean don't have enough money? Well, everybody's taking their money out, and they're loaning the government money. T-bills. So again, when you have loan growth is slow, that means commercial lending is slow. And that means consumers are stretched, and businesses are borrowing like crazy, and they really are right now. And banks can't grow earnings without loan growth. So when you hear these banks and these earnings, and they fudge all the earnings, just know that these banks aren't, they're stable. I'm not talking 2008 stuff, but banks can't grow without loans. And so again, stable, but not strong. Trading, investment banking, okay. They're doing some trading and investment banking, not bad. They're making some money, not booming. Markets are okay when it comes to trading. So these big banks, when they trade themselves, they're doing okay. They make money on customers, okay, who trade, right? Not like they used to years ago. Remember before, if you go back, and people were getting paid, brokers are getting paid in today's money $200-300 a pop. But back then, remember, they worked for it. They work for it. So when discount brokerage came in, what'd they do? They said, oh my God, we can't make money on $5 to $15 a pop in discount brokerage from $200 down to $5. So let's go in and buy the stocks first. And then we'll mark them up to the traders. So you got what we call tourist traders who don't know what they're doing. They're going in and buying stocks that are at retail. Now, you can't go to Brooks Brothers, buy a suit for $500, think you're going to go in front of the store and sell it for $1,000. That'd be stupid. Well, that's what's going on in the market. People are buying stocks. They're terribly overpriced. You're buying retail, trying to sell retail. And then when markets start selling off, nobody's shorting. Oh, don't short. It's a kiss of death. Don't short. So again, everything's going, I'm not here to tell you the banks are crashing, not at all. But what I'm telling you, the expectations of this stock market, it's going to just keep going up and up. It's never going to come down again. Nothing but bull markets. It's a bunch of BS. We have never been so close to a crash. And the truth is, just go look at Warren Buffett's indicator. Right before the dot-com crash, we were about, I think, 115. Right before the housing financial crash, I think we're at 120, something like that. We're at 229. The Buffett indicator's at 229. If we got a crash, the dot-com crash, let's say at 115, we got the housing financial crash at 120, why are we going to be so lucky to think we're not going to get crashed at 229? Now, do we worry about when we trade? No. We just keep it in the back of our head, and we make sure when we're trading, okay, and when the market opens in the morning, you don't go in and buy at 9:30, that's for sure. More money is lost at 9:30 and between 1 o'clock and 2 o'clock than like crazy. When you go in the morning and start trading, people don't understand. You've got to first see if your stock is going to hold the high, the opening high. If you can't hold that opening high from 9:30 to 5 after 10, and the opening high drops to a new low between 9:30 and 5 after 10, and you're buying that stock that day, you're going to get crushed. So, again, these banks aren't in trouble, but they're not growing, and that's hurting jobs, hurting the economy, hurting the stock market. The only thing that's driving this market are 3 tech stocks. Ridiculous. So again, financials, remember, they control the flow of credit. And the economy's auction, and remember, the economy auction is credit. And we have to, my partner, and the economy, oxygen is mortgages, business loans, credit cards, auto loans, commercial loans. And when you start seeing the interest rates are up because the government's competing with us, because the government's telling everybody, hey, I'm going to spend more money than we're taking in. Oh, and guess what? I'm going to borrow money from you. You know that $5,000 you got in your savings account that you're getting 2% on? How about if I give you 5? And they go get the money and, okay, I'll take 5%. We're competing with the friggin' government. How fair is that? Is that stupid or what? That's what we're doing. We're competing with the government. They're pushing us out of the way. It's like standing in line at the bank, and this big guy comes in, and I'm now the third one to get to the window, and he pushes me back to number 5. That's what that's what the government does every day. So that's why we're heading for a hell of a correction in this market. But Trump has been able to keep this market up, okay, by, again, playing with the yields. It's all about yields. And if you look every day and watch your yields, the market only does well if yields are very close from, let's say, you went from 4.3 heading down to 3.9. 3.9. If they're at, let's say the yields right now are 4.3, just use 4.3. If they start heading to, if they start heading to 4.50, 4.5, 4.7, you're going to have a crash. So watch those yields like a hawk. Got to watch those yields like a hawk. And if you yields are everything. Yields will tell you exactly when the market will crash. You just got to know how to read them. And that's why we're here. We'll help you. philsgang.com. Thank you for listening.
Are you nuts?